Doug Ramsey is joining us back from the Leuthold Group. He's the Chief Investment Officer. Doug, it's always a pleasure to have you here. The S&P is looking like we just trampolined off 3K this week. Can it hold?
I'm skeptical. We continue to be somewhat underweight equities. I mean, we don't have a huge bet against them. In our tactical funds, we can shift net equity exposure between 30 and 70%. We're 47, 48% right now. The interesting thing right here is where valuations already are in this supposed new bull market that's not even 4 months old. I mean, we are right back to close to the valuations we made at a speculative market peak just 5 months ago. I mean, it's incredible. I mean, our most trusted, longest running valuation measures for the S&P 500 are mostly back in their top historical decile. That said, it's well-known valuation's not a timing tool, but it certainly helped us in February because we were saying largely the same thing with a completely different economic scenario.
I remember, Doug, and now that you see that the market is just snapping back, how do you make sense of it and fit it into a view that is looking at valuations? Because right now these valuations, when you look at it next to the bond market, people say forget it. Anything that history tells you, the textbooks, tear them up. We had to tear up the economic textbooks because our depression or recession was basically just on paper. Everybody was getting checks in their pocket. That apparently was the only analysis we had to do at the time.
It's interesting looking at where bond yields are today. I mean, obviously, people argue that justifies high multiples, but I would argue that where rates are today, and I mean that 10-year yield is bouncing around not too far from the lows that it made back in March. I think that's very telling. I mean, that the growth outlook is very subdued. And if you do any sort of simple discounted cash flow or dividend discount model, if the drop in the expected growth rate is commensurate with the drop in the discount rate or the interest rate, then there's no justified increase in equity valuations. But certainly investors aren't buying that right now. I mean, it's certainly, again, this case of Tina. There is no alternative.
Doug, when we think about the just kind of practical situation, or just kind of the more actually, let me take that back. The more kind of theoretical way to view this, which is rates don't have any real economic ties anymore. I mean, we saw in 2019, Powell cut 3 times while the economy was heating up. So rates moved inverse to inflation. So if we use that as our baseline, that rates don't really reflect the economy, then maybe we have a period where there could be growth. And moreover, if we just stopped a recession in its tracks with policy, why wouldn't investors just take all the risk that they can?
Well, clearly they're doing that right now when you look at the things. I think, the big issue, if a real recovery takes hold, if this really was just a short-term economic and market air pocket without longer-term consequences, and I'm skeptical, then there's going to be a massive rotation out of these overvalued growth names and into the deep cyclicals. And, we saw, I mean, in this entire 3-month bounce, there was really a broad 3-week surge there beginning in mid-May. But I mean, just look at the divergence, and some of it is being closed today. But I mean, look at the divergence just over the last 3-4 weeks. We topped on the S&P on June 8th. I mean, the Nasdaq never blinked and it's just rocketed higher. And of course, the FANGs have done even better than the Nasdaq. But look at the rest of the broad list. I mean, small caps, mid caps. We like to look at the value line arithmetic composite as sort of a measure of the average stock. I mean, a massive divergence here, which really extends all the way back to the internal peak of the U.S. market and the global market in January of 18. But we've just seen it, a remarkable divergence here on just a short-term basis. And again, if there were real confidence that we were going to go back to close to full employment over the next couple of years and really have a robust recovery, I think there'd be a massive rotation into those cyclical small cap, high beta areas, and we really haven't seen it yet.
Does that will that then be a sign if it happens that this is real? I mean, do you have to see that kind of confirmed, Doug, or does the NASDAQ out on its own show strength in this economy enough? I mean, can we live on Facebook and Netflix alone ad infinitum, or do you need to have that rotation happen? Will that be a confirmation that we are indeed turning around?
I think it will be. I don't think you can survive, or the sort of flight to quality, so to speak, has been unusual, and that it's been the most expensive stocks that were the leaders of the last bull market. I mean, you're right back to the old leadership. Usually a new bull market has completely different leadership, especially after it became as pronounced in U.S. Large cap and mega cap names as it did in the last several years. I mean, that being said, just where valuations are, even if the economic numbers exceed our expectations, I don't see us getting back to that 70% maximum equity exposure because of where valuations are. I just think you've borrowed a lot of the returns from the current bull market. If indeed this is a new bull market, we're at valuations today that took 7 or 8 years to achieve in the last bull market. So I don't see an opportunity. I mean, barring a big setback here, for us to get really aggressive on equities.
As we speak, by the way, the S&P 500 takes a hit here. Just wanted to point out for our viewers, the Florida coronavirus case rises by 10,109, the biggest daily increase since the pandemic started. Just an update here seems to be causing a bit of a reversal here from the early strength. Doug, to keep our conversation going, though, right now, there is this momentum trade, and while the fundamentals maybe aren't clear yet on how they support it, at what point do we sort of view the potential for that big, frothy kind of blow-off moment of this decade? It seems like we got close to it a few times and got stopped short. We got close to it in late 2017, early 18, synchronized growth, and then we got stopped short. Trade war. And then it started in 2019, early 20 again. We started ramping up, and then the COVID thing hit. I mean, it just seems like Americans are ready to buy homes. They're ready to spend. They're just loading up as much as they can online right now. FedEx says it's like Christmas during this crisis. So how do you fight that, though?
Yeah, I understand what you're getting at. I mean, the remarkable thing is, I mean, we're at valuation levels on some measures. I mean, price to sales, price to cash flow, price to book that were, last seen during the late 1990s. I mean, during a wonderful economy. And here we are in the worst economic scenario in our lifetimes. But as long as there's something that captures investors' imaginations, and in this case, it's the money printing. I mean, modern monetary theory went from dream to reality in just the space of 14 or 15 months. I mean, the first time I ever heard of MMT was early 2019. And here we are 18 months later, and it's reality. I mean, it's not a coincidence that federal outlays are up 23% year over year, and M2 is up 23% year over year. I mean, it's just outright underwriting of our fiscal outlay. I mean, it's a remarkable thing, but the equity market has priced in an awful lot of it already.
Does that mean then that our valuation metrics that could have been warning signs before are broken, though, Doug? Because to come back to the beginning here, I mean, I say this a little bit, not sarcastically, but I just say it kind of hypothetically. If this really is an example that we have enough dominance on the economic global stage to print ourselves out of a recession, stop it in its tracks. I mean, why would investors not load up on every risk asset you can if we've got that privilege right now?
We'll have to see. I mean, these valuation measures were certainly premature in the late 1990s. I mean, that was a tough time for our shop as well, cutting equity exposure prematurely. I mean, the other part of it is just getting the leadership long and short, right? But we're just not ones to, throw away over a century of history, and believe in something that's largely untested. And then think about, what do we have to fight future downturns if we've already pulled all these levers? And of course, that was a concern late during the last expansion because we never got rates up to a serious hurdle rate for investment. Well, of course, now we've seen what we can do, just outright printing in support of the boost in fiscal stimulus. But
Yeah.
At some point, just the stimulus is going to wear off. I mean, certainly the stock market has responded, but we'll have to see what sort of shape this bounce takes. My concern is we'll have a rapid bounce back to a lower level of activity than we were running just 5 or 6 months ago. And given the leverage, both operating and financial in the system, earnings are going to suffer significantly as a result.
Yeah. And hey, I think it's a very fair point. We've got permanent job losses here. Hey, Doug, just real quickly, the most bullish thing I see in your report right now looks like a breadth thrust. Can you walk me through what that means here in about 40 seconds?
Oh, sure. There are a lot of ways to measure the breadth thrust. I mean, looking at like the 10-day ratio of advances relative to declines. I won't get into the more complicated way we look at things, but a lot of these same measures signaled around that time it was actually June 5th. What's interesting, and of course, there's still plenty of time for this to be rectified, is we've had the worst follow through from a breadth thrust from the cyclicals in the broad market that we've ever seen in the 60-year history of these signals. So I think that's saying that, maybe that breadth thrust signal that we got way after the turn was more of an exhaustion rather than a blast off. I mean, that's kind of the read I have. And of course, valuations have never been higher than they were at the latest signal. So we still tie in valuations to even some of these technical things that we're watching.
Doug, always a pleasure. Great to have you here. A really good conversation.
Thank you so much.
Strange times we live in. Thanks a lot. Doug Ramsey, Chief Investment Officer at the Leuthold Group.